Good morning, your average investor. Today we're going to take a look at NIO, the Chinese electric vehicle stock, and see if it might be a buy, hold, or sell position. Interesting stock. It's been around for quite some time. About 2018, they did their initial public offering, or at least announced it. And when the stock came out, it was publicly offered for, I believe, in the $5 range. I think it was, or maybe six. You know what? Excuse me. It was about $6.26. And so right now we're below the IPO price. So is it a good time to purchase? You know, there's a lot of talk right now, and a lot of these Chinese stocks today, Alibaba, NIO, things like that, have spiked due to the rate cut, as we do believe there might be a China rate cut to follow the Fed cut. So we're getting a lot of action, or we're getting a lot of percent build during these types of increase or discussion news-wise. So taking a look at it from a whole and a holistic standpoint, over the last 5 years, it had a huge spike back in the 2021 EV era. Things like Tesla, Rivian, some of these other ones, even Fisker, had a nice spike. They peaked, the NIO peaked close to about the $62 range, and it has since had a steady decline. Now, the nice thing about NIO is they also pride themselves on their battery distribution and what they're doing in the battery market. So we do see some differentiation as far as what these guys have to offer in this space. So when we're looking at the electric vehicle industry as a whole, it has been growing pretty fast pace. It's, the challenges remain though, and one of the huge issues from a consumer standpoint is the slow battery charging times and the availability of the current charging infrastructure. And I think a lot of people realize this is, once they have one of these vehicles, how do I get from, Texas to Florida, or, Florida to California if I want to drive the whole country? You literally have to plan your entire travel or your entire trip around where these EV charging stations are. So that's been kind of a large concern. In the infrastructure market, from the reports that we have read, it's expected to grow at a wonderful rate of about $7 billion to $100 billion in the EV supply arena by 2040 is, I think, what the projection was. So it's about a 15% compound annual growth rate, or 15% CAGR. So it's interesting because from the U.S. Department of Energy standpoint, they announced a $1.7 billion increase to fund to help a lot of these plants transition and get them up to snuff on the electric vehicle component. So EV battery technology, the advancements due to the environmental impact of the internal combustion engines, a lot of teams and groups have been working pretty regularly around the clock to solve the current problems faced by the whole EV batteries. I remember during the COVID era, during some of the flooding, they were showing photos of some of these EVs on full fire, and fire. The firemen and fire communities, they couldn't put these batteries out. So just something interesting to keep your eye on. Some of these are using X-ray technology to discover the hydrogen molecules from the batteries, like internal cathodes. They were providing a weak performance, so they're trying to fix some of that. Overall, though, the stock, and as we just said, Alibaba, JD.com, NIO Stock, they're surging after the China interest rate cut in the new stimulus. So that's something to keep your eyes for. And a piece of the puzzle is this nice stock news right here. 29% share price climb, and that's as of yesterday. So it's done a nice job rebounding, but we're still not even at the historical IPO levels. If we take a look at the 6 month, we've come nice up from 370 to this morning. I think we were like 572 when we first 570 when we first opened, somewhere right around there. So it's done a nice job. Overall, love to hear your guys' thoughts, comments, commentary in the comments. Please let us know what you think. And again, if you haven't already subscribed, please do so we can help monetize this thing. Hope you all have a wonderful day, and let's get after it.